So we're looking at income, and we know that income is any money coming into a trust. So we have the public trust, right? We have the private trust. So we want to make a comparison. Let's say the public trust is of the state and the private trust is of man, right? So in both of these trusts, we have trustees. The public trust has the public trustees, public officers. They're responsible for assets which they receive for them to manage and administrate and then to run and fund the whole shebang. And they have to, they're also responsible for the accountability of everything they receive, all these assets. And these assets, they're coming from its creditors. So their accountability is to its creditors, right? So by default, they are already debtors. They're receiving. They're the receivers of private property, which are valuable, and they're put in trust. And the public trustees are in charge of that. They're responsible for that. They got to administrate it. They got accountability. They got to be accountable. So now the private trust, right? The private trustee is responsible for accountability of the assets which are extended to credit the public trust. Right? So the credits that they get, the creditors, boom, right here. They're the creditors right here. So whatever property of value, whatever assets is extended here, they can use it to fund and to basically as credits. So what kind of assets? Okay, so we can look at the assets as being bonds, being bills of exchange, negotiable instruments, promissory notes, basically, these things right here, securities, negotiable instruments. So these assets of the trust, they can go over here, right, to credit the public trust. Bam. And then and so what happens, how does the public receive these things here? Well, let's say there's a public person and he has depleted all his credits. So now he needs to charge back up. Like when you charge a phone, you charge a battery. So you gotta put some plus signs on it. So you charge it up. So these different assets, when it's tendered over here on this side, it charges a person and it does a plus and adds some plus value to the account of this public person, right? And this whole event here creates an income, or it produces an income for the public trust, right? So this income of the public trust, it comes by means of by the acquisition of assets, trust property. Acquisition meaning they acquired it from here. So when the trust, whereby because of this asset coming here, this trust is the creditor. The trust credits the public person, charges the public person, credits the public person. Balances the accounts. If this public person goes in a negative, boom, bam, there you go. Give a little bit of positive right there. So this private trustee reports the acquisition, right? The assets being acquired, reports the discount. Why? Because maybe this right here, when it's tendered over here, there's always an interest because they're borrowing. So this is right here. This is the lender right here. Understand? So the trust is a creditor to the person, but is also the lender on this side. And right here is the borrower. They're the borrower. So the acquisition has to be reported. The discount of the note of the security that was discounted, and it was tendered over to this side by a negotiable instrument. So where's it tendered to? Well, first of all, it's reported to the IRS, and it's tendered to the Treasury. So basically, it's like, okay, the charge is produced. Boom, I'm gonna charge you, bro. We're charging you, just giving you notice. Right here on this side, I'm gonna charge you up. All right. He's like, okay, I need some charging. I'm depleting. So then, okay, perfect. So he sends a bill. But then on this side, the trustee accepts for value the bill, tenders it to them right here, and says, pay to the order of the Treasury for credits over here on this account right here of this person. Right? So I want to report the acquisition to these people right here so that they can go get back this thing right here. So give them the rights to the interest of this, so that they can go collect the interest by means of saying, oh, I'm here to collect the tax, when they're actually just collecting the interest for the creditors. So all tax that they collect over on this side right here is supposed to be the interest that is owed to the private creditors. And the private creditors is just basically giving rights to the interest to them, so they can go collect it. When they do collect it, they're collecting it by means of saying, I'm here to collect the tax. So by tendering a negotiable instrument, bam, now that it covers everything here, everything gets balanced, right? So the trust is now has the right to receive whatever was tendered, that value back, you know. So that's income. That's what I understand it to be so far. But again, it's here and there. Right, we're still learning. We're still learning. Not legal advice, just giving you a perspective of how it seems to be working behind the scenes. What do you think? Do you think this is kind of like what's happening? What do you have to say? What do you have to add to this right here? This seems very, very interesting right here.